Hello, and welcome to another episode of The Laughing Retirement. And in this case, today, we're going to talk about the hierarchy of investments, what you want to own and what you don't want to own. After all, there's a huge barrier to what you own, and that's how much you're paying other people to own something. Now, if I said to you, the cost of your investments are 20%, you'd say, no, it's just not true. At most, I'm paying 2.25%. Some of you may be only paying 1.75%. But let's take a look at what happens. If the stock market averages 9.75 or 10%, and you're paying 2%, you're paying 20% of your earnings, aren't you? Now, we don't think of it that way, but that's the truth. Over the long haul, the stock market averages about 10% a year, the S&P 500, give or take. If you're paying 1% to your financial advisor, that's 10%. If you're paying another 1% to your mutual funds and ETFs and everything else, that's 20%. And if you own an annuity or you own something in a life insurance contract, you're paying more than that. So you wonder why you can't get ahead. And you wonder why the industry says over and over and over again, you aren't saving enough. And you wonder why the suits at Merrill Lynch said you need over $700,000 in order to retire. And you don't have enough. You wonder why. Well, the why is you're paying 20% of everything you own to start with to somebody else. Let's take a look at that for a second. I'm going to share screen here, and we're going to take a look at the hierarchy of investments. There you go. There it is. Best to worst. Now, what are the worst things that you can own? The worst things are actively managed mutual funds. Now, why do I say that? I say that because everybody under the sun has already said it before me. John Bogle, the head of Vanguard Funds, has said they're the worst thing in the world to own. Jeremy Siegel agrees. Professor Jeremy Siegel, who wrote Stocks for the Long Run. Warren Buffett agrees. There are hundreds and hundreds of people out there who know what they're doing, who already say mutual funds are terrible. Now, what's one bad thing about mutual funds? Well, the first is the fee, obviously. But to me, that's not even the worst thing. The worst thing is something called turnover. Now, every time I press the button and I buy a stock, I lose money. Why is that? That's because there's a bid price and an ask price. One is the price you buy it at, and the lower of the two is the price you sell it at. And that's the price that's quoted you every time you look at the price of a stock, or net asset value every time you look at the price of a mutual fund. So if you've got a mutual fund that turns over 50, 60, 75% of the time, every time they buy another stock, they're starting out at the bottom and you're losing. I've used the example of DIA as an ETF, which goes through periods of activity and inactivity. The Dow turns over maybe once a year, maybe 2, 3, 4, 5%, maybe 1 or 2 stocks a year out of 30. And this particular ETF can trade 0 to 20%. Why is that? It's not because they're making money for you. It's because they're making money first for themselves. And that becomes the issue. So what's next? Insurance company wrappers, annuities or indexed annuities or indexed life insurance policies or whatever. I've owned them. I know what they look like. And I also know that very often in an indexed annuity, you will see something called a cap. What's a cap? Well, that's a cap on how much you can earn, not a cap on how much the insurance company can earn, or that the mutual fund can earn, or that the indexed fund can earn. That's, I got to have money myself. Not you, not for you, but for the company. See, you're not first. At the financial services dinner table, you sit last. Your advisor, he or she's going to get paid. Congratulations. The insurance company or the mutual fund company, they're going to get paid. And they're second. They're sitting right across from you. Your advisor is sitting over here to your right, head of the table. To the left of the table is the guys who manage the mutual funds that you're in. They get paid next. They know exactly how much they're going to get paid every year. But you don't know how much you're going to get paid. One of the things you need to look at is upside versus downside capture. Now, this is a simple number that you can find in Schwab, and it says that the mutual fund earns 90% of the upside of the market, but it loses 120% of the downside of the market. That means when the market goes down, they're going to do 120% worse. When the market goes up, they're only going to get 90%. Do you know how often I see that in mutual funds? All the time. Turnover, upside capture and downside capture, two different things, but two different things that work against you. Now, when I say you're paying 20% for your return, depends on what you own. Now let's look in the middle. Let's go down a bit here. I'm going to drop down. I've mentioned fund of funds. They're terrible. A fund of a fund of a fund. It's a fund that has a group of funds in it. Man, you don't know what you're paying. You don't know how much you're getting in turnover. Target date funds. Look at how they're doing versus their indexes. If I was going to have a target date fund, I'd make one myself that started out at about 60-40, 60% stock, S&P 500, maybe 20% international across the board, an ETF, passively invested. And then I'd have 40% intermediate bonds in an ETF that was not actively managed. Maximum fee, 0.05%. That's it. Turnover, less than 5%. That's it. Now, next is down, passively indexed mutual funds. What's wrong with passively indexed mutual funds? Well, I'll tell you what's wrong with passively indexed mutual funds. It's a mutual fund. If you're going to own something that is passively indexed, don't own a mutual fund, own the ETF. It's less expensive to run. It's more transparent. What's in the middle? ETFs. Now, there's indexed ETFs. They have the low cost, no turnover, low turnover, and check the yield versus the index yield, the yield of the ETF versus the yield of the index. Now, we've showed you already in another video that DIA, which mirrors the Dow Jones, does not pay what the individual stocks of the Dow Jones paid. Who's taking that? I would imagine that it's the company itself. See, they're paying themselves first, and they're giving you the leftovers. That's why I said it costs you 20% of your return to invest. If the average return on the S&P 500 is 10% and you're paying 2%, you want to know why you can't get ahead? That's a reason. So what's the best thing to own? The best thing to own is individual stocks. Stocks that pay you for the risk you are taking in a company that you can understand what it does. You reinvest the dividends or you take the dividends yourself if you're in retirement. Otherwise, you reinvest them and you don't sell your gains. What's the cost of that? Zero, zip, none. So who gets paid? You do. Not the mutual fund company, not the ETF. Is it difficult to learn? No, I don't think so. A guy I know who writes Global Intelligence Newsletter says, Jeff Updike says, if you can color inside the lines of a coloring book, you can learn to buy good stock. And I can show you how in 4 steps. Now, in 2022, and the markets were down 20, 30%, my simple individual stocks that pay me for the risk I take were up 3.49, 3.54% for the year. It doesn't cost a lot to get rid of the cost of investing. You should put this in your favor. And that's what this is about. Putting as many marbles in place in your favor as possible, eliminating all of your barriers to earning. That's what this is about. Now, this has been 12 minutes and a half. And we have talked about the barriers to investing. You want to know why you're not earning, why they say you haven't saved enough? God only knows how much you would save if you had to save without their expense, without them taking from you first, and without you sitting forth at the financial dinner table. Oh, by the way, if you think I'm full of crap, I'd like to hear that too. I spent 40 years in the financial services industry. I've been an advisor. I know what it's like. I've made every mistake you can think of. Once I started looking at retiring, I changed my mind about a lot of things because I realized what retirement meant to the retiree. And I realized what saving meant to the person who wanted to retire. So whether you're watching this and you're 25 years old, or whether you're 45, or whether you're 60, there's a way for you to have more. There's a way for you not to withdraw down your investments. It's really quite simple. Subscribe, if you will, to this video series. Join the Laughing Retirement community on Facebook. My name is Chip Stites, and I'm the creator and author of The Laughing Retirement. It's been a pleasure.